Hey, what's up? What's up? What's up? Welcome to Be the Boss of Your Money with Mitch Goldberg. I'm so glad you joined me today. We've got a couple of things to cover. What a weekend, what a day. And it ain't over yet. We're going to have plenty more fireworks to go on. This is going to be good stuff. So let's get into it. All weekend long, all you heard about was, if you follow business news, UBS, Union Bank of Switzerland, taking over Credit Suisse. So odd that when I got into the business, into the industry, close to 35 freaking years ago, Credit Suisse was like a powerhouse bank. Like if you worked at CS, Credit Suisse First Boston, you were successful. You were doing really well. That was such a successful, prestigious bank. But scandals, bad bets, piss poor risk management has just basically made the bank a titan of a balance sheet, big assets, but no real profits and no real respect for a couple of decades now, like the last 20 years. But they've been losing deposits a lot for the last couple of months. So what you saw happen with them, with their takeover and a potential global bank crisis, because this is one of the big banks that's too big to fail. It's been going on for months that depositors have been taking money out of the bank. We're just hearing about it now. You don't hear about it until a bank reaches a tipping point, and then all of a sudden you hear about it. Silicon Valley Bank too. They didn't just have all of their depositors start taking their money out like a week and a half, 2 weeks ago. It had been going on for months, but finally they reached a tipping point when they ran out of short-term assets to cash in, to make sure they had cash available for their depositors to take withdrawals. But they didn't time it well, and they ran, Silicon Valley Bank ran the bank like a hedge fund, not like a bank. They did a carry trade, which means they would borrow short-term, right? Which is your deposits. That's why banks pay you so little. That's you when you put money in a bank, you're basically lending the bank money for next to nothing. And then the bank is taking that money and they're investing into something else that can give them a higher return. And that's how banks make money. Okay. Hey guys, do me a favor while you're watching this, give me a thumbs up, a heart, whatever reaction is available to you, depending on which social media platform you are watching from. Well, we have two comments. A very important person. Hi, Dad. Hi, Jesse. Keep up the amazing work. Oh, thank you, Jess. It's so sweet of you. Thank you very much. I will do my best. We got KO. KO is out there. What's up, buddy? I love following you on Facebook. Always like inspirational video, cameras, content, lights, music, all the electronic stuff that I love to get into. So briefly, some of the news. I was on News 12 over the weekend, and I think I still might be in the loop today, but I was on this morning on News 12 talking about this stuff. So a couple of quick things, and I just want to roll right into a few more important things. We're going to roll the introduction because I always forget to do that. And hold on. Rita, thank you for the heart. Thank you so much. Hey, I hope to see you this week, Rita. That's going to be a good trip we're all taking. All right. So let's roll the intro before I forget. And we're going to talk about Social Security, retirement, and a few other things. We're not going to just spend the whole 10, 15 minutes talking about banks even more. Okay, here we go. All right, we're back. Thank you so much for joining me. We're just getting started. I'm Mitch Goldberg, and it is a pleasure to have you. I will be there. Okay, Rita, I'm looking forward to meeting you in person in just a couple of days. I've got a conference coming up, so I'm going to do this today, tomorrow. I'll be out Wednesday night and Thursday night, and that's just a little housekeeping. So over the weekend, a lot of news came out, but we had a global systemic risk of contagion, bank contagion, catastrophe, had UBS not taking over Credit Suisse, we would have had a new Black Monday. October 19th of 1987 is Black Monday. That's the day the Dow went down over 20% in one day. We would have had a similar day today. We would have called today, March 20th, would have become your new Black Monday. So I think it would have been that bad. Luckily, that happened. Flagstar Bank is going to assume the operations of Signature Bank. Flagstar is a unit of New York Community Bank. New York Community Bank owns a bunch of banking brands. So NYCB is the holding company. They own Flagstar as one of their banking brands. So all of these things helped the market recover, brought back some optimism. Things were pretty heavily sold already. So it was pretty easy to see why the major averages would move up. By the way, you can't invest directly into an index, but you could invest in a security that tracks your mimics an index. Today it was not a huge up day. It was just, more like a little bit of relief. The selling abated somewhat, and that's why the market went up today. But I don't think today was like any grand new start of a new bull market. We're running right up to the old highs and we're back in business. No, that's not the case. We have a Fed meeting that starts tomorrow, and this will be a 2-day meeting, so it'll end Wednesday, and then Wednesday at around 2:00, we'll get the announcement of what the Federal Reserve is going to do. Are they raising a quarter point? Nothing. The betting is that the Fed raises a quarter point and pauses. Why would they raise rates 0.25% with all of the turmoil going on? I don't know. I really don't know. I think it would be perfectly fine for the Fed to say, we're aware of inflation, but we all know about the turmoil happening in banks, so we think we should just hold off on raising rates now. It's not like it's a secret. It's not like if the Fed doesn't raise rates that they're going to send some shockwave through the market and say, oh, no, what's the Fed worried about? What do they know that we don't? Everything's out there. We've already had the shock and awe with the banks. And, it happened very quickly. It just, it's like overnight. We didn't start in a banking crisis. We kind of just woke up in the middle of a banking crisis. But I don't think we've heard the last of the banking crisis. I just think that we're going to have up days and down days. I don't get overly excited about either one. I don't get gloomy in a down day and say, oh, I've got to start selling. And I don't get overly excited in updates. Oh, I've got to buy everything back because now we're going back up. I have my own investment plan. I'm a financial advisor. My clients have their investment plan that's in accordance with their overall goals, their risk tolerance, their financial plan. It's more, people think like a financial plan is the end all and be all. I do that. I do financial planning. I use the latest and greatest software, and it's called Money Guide Pro. There's a lot more to taking somebody through the process of personal finance, their personal finance order of what they need to go through. Sometimes I will have a client that comes in and they are financially set for life. Like, they're in their 50s, they've got everything under control. And I go through everything and I don't just look at their money and extrapolate what they're going to spend in the future and try to tell them how much money they're going to have at the age of 96 or 94, whatever we decide is the end of plan. We use the phrase end of plan instead of saying when you could die. That's, it's the way we do it. But there's a lot more to personal finance. Sometimes I go through the personal finance order with these clients, the order of personal finance, and it's like they did miss a couple of things. Like they were really good savers, or really good investors. They were really good at spending less than they make, but they've missed a couple of things, either on the insurance side, on the risk side. They're still taking way too much risk for their age, and they haven't dialed the risk back because they're closer to needing their money. These little things that they didn't do, it leaves them so vulnerable when they get close to retirement or in retirement. And that's the worst time for a personal finance calamity, because you don't have the time in front of you to recover and to make more money, keep adding to your 401k plan, for example. So a lot of people miss things, even though they're successful, and you think, oh, they don't need to do anything, just keep doing what you're doing. No, it's not the case. Sometimes they are. You got to check, and that's like a big thing that I do here. If you want to check me out, just check out firststrategy.com. You'll find me there. You'll find my partner, Bobby Bird, there. And by the way, we are growing and we are moving to nice, new, bigger office space. I cannot wait. I'll start posting a lot of updates on that, but I'm really excited for it. All right, so that's just going on with the banks. Today was a relief rally. Maybe all of a sudden people say, well, maybe it's not as bad as we thought, when last week people thought the banks could be in such bad shape that we could have another financial global crisis. I do think the takeaway is that we do move up the odds of a recession, because banks that feel if they're going to lose deposits, if they can bring in new money, new depositors, they're not going to invest that money. They're going to hold on to that money. They're not going to make loans. They want to leave that money in the bank, no pun intended. So if withdrawals happen, they have the money to give to people who are making withdrawals. That means there's less loans available. That means credit gets tighter. This is what the Fed wanted. Don't get me wrong. The Fed wanted this. They're getting what they wanted. But, is this like a sudden massive slowdown in the economy? Does the economy come to a screeching halt? Or does this just slow it down even a little bit more? And maybe this kind of does a lot of the work for the Fed. We shall see. I think this does a lot of work for the Fed, though. So Fed meeting Wednesday. Let's talk real quick about Social Security, okay? A couple of things that you need to know. Social Security is based on, they take the 35 best years of your earnings. So even if you made money like 30 years ago and you're making a lot more today, they index all the money, they index it to inflation, and they come out with a formula that says this is going to be your benefit. So 35 years. If you have zeros in those years where you were completely out of the workforce and you didn't make money, that hurts. So what do? You have to put more years in if you want to raise your Social Security income. And what you do is, and you don't have to make like up to $160,000 and bust your hump to make the full amount. Even if you could just make literally, $6,000 to $10,000 a year part-time, that will actually help you contribute a lot to Social Security. And that'll actually get rid of some of those zeros in that 35-year working history, which will raise your odds of a better and higher Social Security payout. Really important to do. And I realize there are some people that just cannot do that. They have to start collecting Social Security at 62. They have to. They have no choice. I get it. And I'm not trying to be insensitive to people who are stuck between a rock and a hard place. I have an I love you out there. My daughter, okay, I love you too, baby. So these are the things that you need to do. Another thing you could do is, if you can, retire later. When you retire at 62, you're losing about 25-30% of your full retirement age benefit, which if you're born 1960 and later, it's age 67. And from 67, okay, so for 68, 69, and 70, if you could wait, you get an automatic 8% increase guaranteed in your benefit. I don't know too many other places you're getting an 8% guaranteed rate of return, plus you're getting the COLAs, the cost of living adjustments. So I have a friend who just told me he's going to start collecting Social Security, and he's going to collect about $56,000 a year just in Social Security. If you add in the COLAs for that, I mean, literally in 10 years, you could be seeing $90,000 a year in Social Security. Okay, I'm not saying that's what you should live on. I'm just saying Social Security is probably one of the biggest gains you're going to have in your life. So you want to do it right, okay? So these are the things that you need to know. So if you could get in some working years to get rid of some zeros because of years you're out of the workforce, do it if you can. Again, a part-time job would help, okay? If you just find that so unpalatable, maybe collect later. Also, if there's a married couple and one spouse who has earnings, if they can wait longer to collect their Social Security, that'll be a higher Social Security benefit for their spouse. So if you collect early and you're the sole breadwinner in your family, you're actually giving your wife a permanently lower Social Security benefit for life also. So I want to try to help you avoid these if you can. And I know it's a lot of ifs. All right. So we talked about that. Now, when you start taking money out of your accounts, oh, here's what I want to say. In some cases, I have advised clients who are in their 60s to make withdrawals from your IRA, Roth, traditional, make withdrawals or live off some of your savings or brokerage accounts to fend off collecting Social Security. Because the higher income you get later in life in your mid 70s, you're going to really be glad in most cases, almost every case, that you did that. Now, it depends on how you look at Social Security. I don't look at Social Security, get a little coffee here. I don't look at Social Security whereas I've got to try to get the most out. So if I collect at 64, 62, what if I die at 80? And I think I'll be glad I collected, because if I wait till I'm 70, I have to live to my late 80s to make up the difference to break even. I don't look at it that way. I look at Social Security as just a way to get more income for life when I'm older, whether my life is a year long, less, or more. I'm not trying to be gloomy here. I'm just saying I look at it as an income supplement for when I'm older, not as an investment that I'm trying to cash in on a return when I'm younger. But everybody has to do what they have to do. So, if you want to have a talk about this, you're certainly welcome to call me. We could take a look at a couple of different scenarios. That's really about it. That's what I wanted to that's what I wanted to get into. And I'm trying desperately to make these live streams, in 15 minutes. Or already 16 minutes and 52 seconds. So I'll end it here. I'll see you tomorrow. If you have questions, something you want to know about, let me know, because your questions become the best content for me. Because if you have a question, there's a really good chance that other viewers have the same question. Okay. Have a great night. Enjoy the first day of spring, and I'll see you tomorrow.